Welcome back to DIY Finance Guy. I'm Sergei Modilevski. Today's video is going to be for all the bleeding hearts who are sending up a prayer for a bounce back in home prices. There's no need to be living on a prayer. The reality is that amortization and borrowing cost or interest rate is what drives property valuation. Over the last 5 months, we've seen the fastest increase in borrowing costs since 1989. Over that same period, we've seen the most rapid deterioration in home price values, a totally predictable outcome. To see home prices reverse course, we need to see interest rates show a reversal or an objective plateau. Canada's 5-year bond yield has seen volatile trading since mid-June. After dovish comments from the US Fed, the yield went into a free fall before a sobering job report abruptly stopped the fall. Still, bond yields have fallen down 22% from their peak, and big banks are finally reducing interest rates. For property prices to find a bottom, you need to increase affordability. And there's 3 ways that can happen. You can reduce home prices, you can increase borrowing capacity, or you could reduce borrowing costs. This video is brought to you by I'm just joking. I barely got any followers. But if you found this video informative so far and you think it's as informative as I am funny, please hit the like, subscribe, and share so this video gets out to more people who might find it helpful. If you want to get into an argument, leave your thoughts in the comments down below. The Royal Bank of Canada is warning that the housing correction in Toronto could become the deepest in half of a century. But rest assured, this could be true for all of Southern Ontario. We will undoubtedly see lower home prices if the economy is in recession. Employment will continue to erode as it has over the last 2 months, destroying demand from first-time home buyers. Investors will also remain on the sidelines as higher borrowing costs result in lower cap rates and eroding home equity limits down payment options. The acceleration of home price declines may actually help us find a bottom sooner rather than later. This is different from the usual slow grind down that we've seen in the past. Another catalyst for a turnaround in home prices would be an increase in borrowing capacity. Now that could take 2 different forms. If the government removed the mortgage stress test, then anybody looking to qualify for a mortgage would have about 20% more borrowing capacity. Considering the high demand for housing, that could establish a much higher price bottom. We know Canadians have no fear of high indebtedness. Another option the feds may consider is under consideration in the United Kingdom, which is increasing the maximum amortization from 30 years to 40 years. Increasing the loan duration would immediately create an additional 6% of borrowing capacity. This policy shift would have a negligible impact on affordability and divert even more Canadian GDP towards unproductive real estate due to higher interest payments. Personally, I give this option 2 thumbs down. The final catalyst for a turnaround in home prices is a reduction in borrowing costs. That means lower mortgage rates. At the time of filming, HSBC became the first major lender to reduce their uninsured 5-year fixed rate from 5.19% to 4.79%. Now that might seem significant, but in actuality, that's about a 4% reduction in payment, which is pretty negligible. Decreasing mortgage rates have the most significant impact on home affordability, and it's not even close. Not only does it reduce the amount of interest that they're going to pay on their mortgage, but it also increases their borrowing capacity, because a lower 5-year fixed rate means a lower qualifying rate in payment. Inflation is going to be the driving force behind any changes in interest rates and consequently home prices. The US will report consumer price index data on August 10th, and Canada will report on August 15th. I don't want to exaggerate the importance of these reports, but I do believe that this month's Consumer Price Index and Producer Price Index reports will be the big catalyst for interest rates and home prices moving up or down in the months ahead. Commodity prices have fallen dramatically over the last few months, with most energy and agriculture commodities trading near their 1-year low. As a result, consumers and economists are now expecting a decrease or a decelerating inflation rate. If the inflation print comes in below forecast, I believe that we'll see bond yields and fixed interest rates tumble. I think that could lead to a reversal in home prices before the year is out. If the inflation print comes in above forecast, we are all. If you enjoyed this content, please hit the like and subscribe so more people like you can see this content. If you don't want to miss this in the future, please hit the notifications bell so you'll get notified every time I post a video. Thanks for tuning in, and I'll see you in the next one.